When somebody talks about your net worth, what that means is you take your assets minus your liabilities, and this gives you what your net worth is. We're going to do something much simpler here, where I'm going to talk about how you can grow your investment value, your investment portfolio value, to over $100,000. Now, when we talk about investing your money, what I mean by that is you're taking your money and you're investing it into assets, things like real estate, things like stocks, that are going to hopefully work to grow in value, meaning make you money without you having to go to work to get paid. So you're going to work every single day, or you're making money from your business. Now you take some of this money and you are going to throw it into these investments. What are these investments? Stocks and real estate. Now when you do that, the goal is just to keep throwing some money into your investments every week, every 2 weeks, every month. That way you can grow the value of investments, because now you're putting your money here, and when the stock market goes up, you make money. When real estate goes up, or when your real estate pays you dividends from your cash flow, you make money. That's what I'm talking about here. So let's talk about how you can actually make this happen. And there are two strategies. There's two general fundamental strategies that I want you to understand. Number one is what I like to call an active strategy. And number two is what I like to call a passive strategy. Active investing is not trading. I'm not talking about trading. That's not the game that I play. That's a form of gambling to me. Active investing is now you are looking for individual companies. You are looking for specific niches to invest in for the long term. Maybe you like investing in technology. Maybe you believe in the future of healthcare. Maybe you believe in the future of AI, and you're looking for those stocks or those funds to invest in that are more niche. Passive investing is a set it and forget it system, where now you're investing in a broad basket fund. Maybe you're investing in the S&P 500. That's a group of the 500 largest companies in the stock market. Maybe you're investing in the total stock market. Now, you set it and forget it, meaning you create a system where every week or every 2 weeks or every month, money is automatically pulled out of your checking account and is automatically invested. You don't touch it, and this continues happening when markets are up, when markets are down, when markets are sideways. You don't touch it. That's passive investing. Now you can figure out what's the right strategy for you. For me, I do a little bit of both. I have a system where every Wednesday, cash is pulled out of my checking account and is passively invested into the stock market. Why Wednesday? Because it's in the middle of the week. There's no secret sauce for this. It's just been doing that for years, and that happens no matter what. If the markets are crashing, I'm still buying. If markets are going up, I'm still buying. When it's snowing outside, I'm still buying. For my active investing strategy, I'm investing in real estate, which means I'm looking for individual properties to purchase. And I'm also investing my money into stocks actively. I'm looking for specific companies or more niche things to be invested in, where I'm doing my research to find those types of investments. Now again, this type of active investing comes with more risk, but it also comes with more potential return. And this is where you have to remember, investing has risks. You are never guaranteed to make money when you invest. In fact, you will lose money at some point, which is why you need to always do your own due diligence and never blindly trust a random guy on YouTube. But now you gotta pick the right strategy for you. But notice what I said here, stocks and real estate. Those are the two asset classes outside of starting a business that have built more wealth than anything else in the United States over the last century. Now there's a lot of newer asset classes that have been popping up. Things like cryptocurrencies, things like NFTs, things like investing in wine, things like investing in art. These things are more newer, more speculative. Yeah, I get it, art has been around for many centuries, but these are more speculative. And this is where I want you to understand that there's a difference between making a speculative investment and making a non-speculative investment. You can get extremely rich very fast with a speculative investment, but you can lose all of that money just as fast. So if you're making speculative investments, fine, but just understand that it's speculative. That's why for me, when I talk about how do I create an investment portfolio, there's a piece of my investment portfolio that's made for speculative investments. If you're just starting off, you probably don't want more than 10% of your total investment value in speculative assets. As you start to grow your wealth, maybe you can push that up to closer to 20%, but once you go beyond that, well, now you start to take on a lot more risk. And that's why for me, about 80% of my portfolio outside of my business is stocks and real estate. 18% is speculative. That's things like cryptocurrency, that's things like startup businesses, and then 2% is physical gold. Now, how do you actually go about doing this? Let's talk about the numbers now that we understand the way that this works. The stock market as a whole has grown by around 10% a year over the last 100 years. That's actually a little bit more than 10%, but we'll just keep it round at 10% a year. So let's assume that you're just passively putting your money into the stock market, the S&P 500 or the total stock market, through a broad basket index fund or ETF. And so now, if you can assume this 10% average return, the question is, what do you need to do to be worth $100,000? Well, let's assume that you're just getting started. You have never invested your money before, and so now you're just putting your money into the S&P 500 ETF, which, by the way, there's multiple of them. One of them is called SPY. This is the ticker symbol for one S&P 500 ETF. Another one is called VOO. As a disclaimer, I am personally invested in VOO. Both of these are giving you exposure to the S&P 500 ETF. So, 10% returns a year. If you start investing today with $100 a month, well, now it's going to take you 23 years for your money to compound and grow to that $100,000. If you can invest $500 a month, well, now it will take your money 10 years to compound and grow to that $100,000. And if you can invest $1,000 a month, well, now it's going to take you 6 years for your money to compound and grow to that $100,000. Now you got to remember, markets don't always go up. Markets go up, markets go down, sometimes markets crash, sometimes markets boom. This has been the average over the last 10 years, despite the market crashes, despite the booms. Now, the way that you actually build wealth as an investor is through TRM, time, return, and money. The more time your money has to compound and grow, the wealthier you're going to become, which is why you want to start sooner rather than later. The second is R, return. Return is the interest rate that you're going to get. Return is how fast you can grow your money. Return is how fast you can double your money. Now, of course, you can become an active investor to try to get better returns, but that comes with more risk, which is why I say that most people should be a passive investor. Some of you who are more financial nerds and who really enjoy this stuff, that's when you can consider being an active investor. And then you have M, money, which is how much money you invest. The more money you invest, the more money you're going to make. But this is where you got to remember, it takes time. Your money takes time to compound and grow, because in the beginning, when you have $1,000 in your investment portfolio, a 10% return is $100. Doesn't really mean much. But when you have $100,000 in your investment portfolio, now if you grow by 10%, that's $10,000. Starting to become more significant. When you have $1 million in your investment portfolio, a 10% return is $100,000. So you can start to see that the same 10% return can mean a lot more dollars as you have more money. And you're not going to start with $1 million, unfortunately. But this is where you got to start. And the sooner you can start, the sooner you can keep throwing more money into your investments, the sooner you're going to get to the $100,000, the sooner you're going to get to that $1 million. And that's when these smaller returns can seem a whole lot bigger, because they come with a whole lot more bigger dollars. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.